Most traders don't lose because they pick the wrong direction. They lose because they don't actually know when a trend is real, when it's weakening, or when the market is just moving sideways. A few bullish candles appear, and they assume the trend has started, only to see price reverse. Or the market pulls back slightly, and they panic out of a perfectly healthy move. That confusion usually comes from relying on indicators that react too slowly, or flip direction too often. And that's exactly what this indicator is designed to solve. The adaptive trend saber isn't just another moving average or trend line. It dynamically adjusts to market volatility and structure, helping you see the dominant direction more clearly and recognize when that direction is truly changing. In this video, I'm going to show you exactly how to add it, explain what you're seeing on the chart, walk through the settings, and then give you clear long and short strategies you can start applying immediately. To add the indicator, open TradingView and load any chart you want. I'm using the 30-minute time frame here, but this works the same way on forex pairs, crypto, stocks, or gold. Click Indicators, type Adaptive Trend Saber, and select the one by Boss Waves. As soon as it loads, you'll see a smooth adaptive line plotted directly on the chart following price. You'll notice that this line changes color depending on the detected trend direction, and its position relative to price gives you immediate context. Unlike a standard moving average, this line doesn't respond at a fixed speed. It adapts based on how the market is behaving, which helps reduce noise during consolidation and respond faster during strong moves. Now let's look closely at what you're seeing. When the saber line is positioned below price and colored bullish, it indicates that upward momentum is dominant, and the adaptive calculation considers the trend intact. When the line flips above price and turns bearish, it signals that downward pressure is stronger and the trend has shifted. But what really makes this useful is how it behaves during transitions. Instead of constantly switching during sideways action, the line often stays stable until price truly moves far enough to justify a shift. That stability helps you avoid reacting to every small fluctuation. You'll also notice that during a healthy trend, price often pulls back toward the saber line and then continues in the same direction. Those pullbacks are where many of the best opportunities appear. Now, before we get into the actual strategy, let me share something that changed how I trade. You can learn this setup perfectly, but if you're not at your screen when it triggers, you miss it. And that used to happen to me constantly. That's why I started automating strategies like this, back-tested setups that run whether I'm at my desk or not. These work across forex, futures, gold, and they even work at prop firms. If you want access to the exact strategies hundreds of traders are already using, check the first link in the description. Before trading with it, let's go through the settings so the indicator matches your time frame. Double-click the indicator to open the settings panel. You'll typically see controls related to length, adaptive smoothing, or sensitivity. Lower sensitivity makes the line react faster to price changes. This can be helpful for short-term trading, but it may also increase noise. Higher smoothing slows the response, filtering out small fluctuations and keeping the line stable during trends, which is often better for swing trading. If you're trading intraday, start with medium sensitivity, so the line reacts reasonably quickly without flipping constantly. If you're trading higher time frames, slightly higher smoothing can help you stay in trends longer. After adjusting, click OK. Now let's go into how to actually trade this indicator. Long setup. First, confirm that the saber line is bullish in color and positioned below price. That tells you the adaptive model sees upward momentum as dominant. Next, wait for price to retrace toward the line. You don't want to enter after a strong impulsive move. You want a controlled pullback. As price approaches the saber line, watch the candles carefully. If price touches or slightly dips toward the line, but then forms a bullish candle closing back above it, that usually signals buyers are defending the trend. At that point, you can enter long on the next candle. Place your stop loss just below the recent swing low formed during the pullback, or slightly below the saber line itself. If price breaks through decisively, the trend structure may be shifting. For take profit, you can aim for the next resistance level, previous high, or use a risk-reward ratio such as 1.5. Short setup. The logic is the same in reverse. You want the saber line bearish in color and positioned above price. That confirms downward momentum. Wait for price to rally back toward the line. As price approaches, watch for hesitation, or a bearish candle closing back below the line. That shows sellers are still controlling the move. Enter short on the next candle. Place your stop above the recent swing high or slightly above the saber line. Targets can be the next support level, previous low, or your chosen risk-reward multiple. One of the most useful things about the saber line is how it reveals market conditions. If price repeatedly crosses the line and the color flips back and forth, that usually means the market is consolidating. In those conditions, trend trades tend to perform poorly, so it's often better to wait. But when the saber holds one direction and price keeps respecting it on pullbacks, that's when trends become reliable. This simple observation alone can help you avoid many low-quality trades. If you're a serious trader trying to get funded, you need more than a single tool. You need a full toolkit consisting of elite algos that catch the best moves while avoiding losses in sideways markets, proven strategies across multiple markets, whether forex, gold, or futures, with risk management built in, and fully automated systems so you can trade without being at the screen all day. So if you'd like to stop burning your time and account testing random indicators, and start using elite tools and automation like all these other traders, click the link below. Let's quickly tune this for different markets. In forex, medium smoothing works well because trends often develop steadily with orderly pullbacks. In crypto, markets move faster, so slightly higher sensitivity can help, but confirmation candles are still important to avoid false moves. In stocks, higher smoothing often keeps you aligned with institutional trends that develop over longer periods. In gold, the saber line frequently acts as dynamic support or resistance, so placing stops just beyond it often makes practical sense. At the end of the day, this indicator isn't about predicting the future, it's about helping you stay aligned with the current dominant trend and recognize when that trend is genuinely shifting. Instead of reacting emotionally to every candle, you let the adaptive structure guide your decisions. And when your decisions are guided by structure instead of impulse, consistency becomes much easier to achieve. Thanks for watching, and I'll see you in the next one.